Hi, this is Alessio. Hope you're well, and welcome to another update on Bitcoin. Now, before I begin showing you the strategy, I would highly encourage you to please watch the first half of this video, because the beginning part of this video is going to be very important to set the context. So the first thing I want to say is this. There are two main methods or two main strategies as to how you approach a market, especially if you're looking to buy or sell into a market. The first methodology is what's called trend following. Now, I'm sure you've probably heard of trend following or trend reversals. Let me explain this to you in the context of Bitcoin. So essentially, if you're a trend follower, the first thing you'd be doing is waiting for a trend reversal. In other words, a reversal from a downtrend to an uptrend before you would consider buying into a market. So for example, on this daily time frame chart of Bitcoin, as you can see here, a trend follower would say, okay, we're going to draw, for example, a trend line. Okay. Let me just draw this. A trend line could be drawn by connecting these highs, as you can see there. And you could also draw a line across the resistance levels, for example, resistance at these highs. And you could say, well, the trend reversed when Bitcoin broke that trend line, the blue line, and the resistance right there on that bar. Now, that is one way to approach it. I would say that's an aggressive way to approach a trend following strategy, and it's not complete. What many people forget is that for a trend reversal, in other words, from a downtrend to an uptrend, you need a reversal not just on the daily time frame, but also on the higher time frame. In fact, this is an article from one of my favorite chartists and analysts, L.A. Little, and he said this in an article in MarketWatch, and he said a very brilliant point, which I'm going to read for you here. He said, you need a break of market structure. What is a structure? What you need is a break of multiple swing points on multiple time frames. And that is the key word here, guys. And in fact, to give an example on this, as you can see here on this chart, because what you need is a break of multiple swing points, low points or high points, on multiple time frames. And that, by the way, means this. If you just go back to our chart on Bitcoin, that means the break of resistance on the daily time frame chart. For example, that was a resistance here, okay, near just above the 4,000 level, about near 4,300. The break of resistance which occurred there on the daily time frame was not enough to show a break of market structure or a reversal of trend. What was required was a break of swing points on the daily and the weekly charts. So professional chartists and analysts, they don't just look for a reversal on one time frame. They also look at the higher time frame, for example, the weekly charts. And the weekly charts show that you did not have a break of trend or breakthrough structure or resistance until this bar you see here. Why? Notice, for example, on this chart where the swing points are, where are the resistance levels. The swing points were at these levels near the 6,000 level, as you can see right there. I've marked them here on my chart. Those were the previous important swing points on Bitcoin that we had throughout 2018. And Bitcoin did not break that swing point until this bar you see here on the 6th of May, right there on that bar. Okay. And by the way, that also makes sense because it wasn't until this bar here that you had two consecutive closes above the 50 moving average on the weekly time frame. That's the black line you see right there. It's only until you get two consecutive closes on the weekly 50 moving average that you have a very high probability that you've actually potentially reversed trend. And that was also the bar, by the way, guys. That bar on the 6th of May is the bar that broke these swing points you see here. So bottom line is this, guys, that it wasn't until Bitcoin surged through and broke these swing points, multiple swing points on the daily and the weekly time frame, that there was a high probability, therefore, that we probably reversed trend. In other words, going from a bear market into a potential bull market. Now, I know what some of you are probably thinking, and it's a perfectly good question to ask, which is, well, if you're waiting for a trend reversal on multiple time frames, on the daily and the weekly time frames, doesn't that mean you might miss the exact bottom or near these bottom levels or the exact top? Yes, that is true. So this is probably a more conservative strategy, but here's the thing. It also means that you're less prone to the risk of failure. In other words, the risk of potential failure at resistance. Because here's the thing, guys. There was a strong probability that when Bitcoin came up to these swing point levels, it could have actually failed to get above these levels and dropped from these levels. So it was a wise thing to do to wait for a confirmation of a break and close above these multiple swing points before we could say with a high degree of probability that we potentially reversed trend. And in case some of you are probably thinking, well, doesn't that mean you might miss the exact bottom and the exact top? Yes. But remember, guys, as I explained in the interview with Peter Brent, no trader or investor can possibly get the exact bottom and the exact top. All we're looking for is that chunk in the middle, the 60%, okay, let me just write this down, the 60% chunk in the middle. If you think about it like a sandwich, we're not looking for the carbs, the top bit and the bottom bit. We're just looking for that meat in the middle. So if Bitcoin, let's say, went up to 50,000 or 100,000, who cares if we didn't get the exact bottom or the exact top? All we want is that 60% bit or the meat in the middle. So let's go now to the second strategy. The second strategy is what's called value trading or value investing. In fact, I explained this in a video that I published on the 10th of March. Here's what I said about the value strategy in that video. Let me play a short clip. There are some other kind of investors, some other kind of people out there who are, I would call them value investors, value traders. Those folks, they don't really care about trends or whatever, or momentum. They may not even care about chart analysis. They might just say, look, something has dropped so significantly by 50 to 80, 90% that the price has become so undervalued, so depressed that now value has been reached, undervalue, or if you want to call it that. And they would argue that maybe now is a good time, simply because even though it hasn't bottomed, or there has no, or even if there is no significant confirmation of a bottom, that it's still a good time to buy because the price is so undervalued and depressed. I would say there's nothing wrong with that, because those value investors are looking for value, as the name suggests. But I would say this, if you're going to do that, then at least make sure you're protected. At least make sure you're using a stop loss. At least make sure you're risk controlled. Your risk must be limited and controlled. Just go to the next chart for a second, guys. If you just go, yeah. Let me explain to you. For example, if somebody were to buy Bitcoin right now, let's say a value investor, let's say they bought Bitcoin near 4,000. If you're buying at 4,000, then that trader, what they should do is have a stop loss, some kind of mental stop loss or an alert, price alert, that if the price were to drop back down below the lows, below the previous lows, then at least they can get out and quickly minimize their risk. If you're a value investor or a trend trader, you have to have risk control. Either a stop loss or a mental stop loss so you can get out and minimize your risk, or a hedge. Now let's go to our strategy, which is the one I want to talk to you about today in this video. So in this video now, in this section, I'm going to share with you when I'm looking to buy Bitcoin. But the good thing is, in this section, I'm going to explain to you how we can combine both value and trend. So this strategy, which I'm going to show you, combines the best of both worlds. We're combining trend following with value at the same time. Now, before I explain to you that methodology, I want to first of all show you this diagram, because this actually explains my point much better. In a trending market, usually price moves in a kind of a staircase pattern, which I'm sure you're familiar with. Markets, after they make a reversal of a trend, they usually move in this kind of a staircase pattern that you see here. So markets go up, then they pull back to an important support level, and then they bounce off, and then they pull back, and then they bounce off, and so on and so on. Or a series of higher highs, higher lows, which of course distinguishes a trending market. But what's also important to know about a trending market is this, that it's very important that we're protected against risk. Because every time we're considering to buy the pullback, so for example, a trend trader would be looking to buy the pullbacks to support. But all trend followers and trend traders know there's a strong risk of loss, because there's a strong probability that the next time we look to buy a pullback, price might do something like this, like you see here. So you think the price is going to make a pullback, and then what does it do? It doesn't hold the support, and then suddenly it drops further lower. And that's why we need to be mindful of risk and to know we're protected. That means as a trend follower, if I'm looking to buy at the next pullback to support, I'm going to put a stop loss beneath the previous low point. So if the price does something like this, I'm protected against making a significant loss. All right, guys, let's take a look now at this particular strategy. As you can see here on my chart, I have these moving averages. Now, you might have seen these moving averages on my chart before, but for those of you not familiar with moving averages, I usually have at least 3 or 4 moving averages on my chart, and these are the ones you see here: 21, 55, and 100 exponential moving averages, or EMA, and the 200 moving average. And this is what's important. I need to have these moving averages lined up in this direction: 21 above the 55, 55 above the 100, and the 100 above the 200. Why like this? Because when the moving averages are lined up like this, that's a key distinguishing characteristic of an uptrend or an uptrending market. And here's what's important to appreciate, that in an uptrending market, what usually happens, that when you have these moving averages lined up like this, usually price comes down to the 100 moving average, for example, the 100 exponential moving average, and holds this level and bounces off. In fact, as you can see here, this happened many times before on Bitcoin. Let me show it to you on this chart because it shows to you much more clearly what I'm talking about. Notice in 2017, for example, how many times in a trending market, price came down to the 100 moving average, bounced off. Came to the 100 moving average, bounced off and rallied. Came to the 100 moving average, bounced off. As you can see here, held this level, bounced off, boom. Then came down to 100 moving average again, bounced off, and so on and so on. And by the way, this does not just happen on Bitcoin. It happens on other markets too, like gold. Gold did the exact same thing during its uptrend in 2010 and 2011. And by the way, guys, one more thing to mention here is that the 21 weekly moving average, the 21 weekly EMA, is usually about the same price level as the 100 daily moving average. So price has a habit of touching and testing the 21 weekly moving average as well. As you can see here, this happened on Bitcoin during 2017. Notice how many times it held this level, bounced off, as you can see here, from the 21 weekly moving average. All right, guys, let's go now to the charts of Bitcoin. Now, on this chart of Bitcoin, which I have in front of me right now, I have, as you can see here, the 21 daily moving average, the 55 daily moving average, and the 100 EMA, and the 100 SMA, the 100 simple moving average. The reason why I have both the 100 EMA and the SMA is because sometimes price can come down to either one of these levels, so we don't know which one of these levels might get tested. And what I'm looking for is a potential pullback down to the 100 EMA, that's the orange line you see here, and the 100, potentially the 100 simple moving average. So that's the kind of levels I'm looking for a potential pullback on Bitcoin. By the way, there's another level right in between these moving averages, which I'm looking at, which is the 5,880 level. That's the red line you see here. Why is that level important? Because that's a level that Bitcoin has tested before many times. If I just pull back this chart, you'll see why. That is the level that Bitcoin tested many times during 2018. You see right there. So it's potentially possible that Bitcoin may come back down to test that level once again, which, by the way, comes very close to the 100 EMA and the 100 SMA. So just zooming in on that section of the chart here. So what we're looking for is a potential pullback. Let's say, for example, that Bitcoin were to drop from here. Now, of course, we don't know if Bitcoin is going to drop down from here, but let's say it did. Let's say Bitcoin started to pull back either from these levels or let's say from higher levels. Let's say Bitcoin started to pull back down to the 100 EMA. So I'm going to start nibbling on a small position near these levels, near the 100 EMA. Now, if it were to continue coming lower, for example, down to the 100 SMA, I'm going to start nibbling and starting a small position at this level as well. In case you're wondering why a small position, their simple reason is that while there's a probability that Bitcoin may hold these levels, there's absolutely no guarantee or certainty that Bitcoin is going to hold these levels. There is always a risk that Bitcoin may not hold these levels and may just continue falling lower. All right, guys, so there's always a risk and possibility of anything happening. So remember, guys, all professional traders and chartists are always mindful of risk, which is why I showed you this chart a moment ago. Because if this happens, if price were to pull back and drops further lower than we expected, we need to be protected against the risk. That means this, by the way. That means if I'm looking to buy at these levels, again, the 100 EMA, the 100 SMA, and this red line I'm looking at here, then I'm going to have a stop loss just beneath these lows, beneath the lows that Bitcoin formed here back in April, which is about the 4,800 level, maybe just beneath these levels here. Why? Because if Bitcoin were to drop down to these levels and continue dropping, then at least we're protected against risk. Now, let's say, for example, that Bitcoin were to drop down. Let's say Bitcoin did drop down, whether these levels or at higher levels. Let's say it dropped down to these levels, the 100 moving averages, and let's say it held these levels and then bounced off that level. And if it were to bounce off these levels, then I'm going to start adding to my position, because then I have a clear indication that there's a higher probability that Bitcoin is holding these levels and may start the new leg higher towards the previous highs. So this essentially is a very useful and simple strategy which a trader could use to combine both trend following and value at the same time, but also to control the risk as well. All right, guys, before I finish the video, I just want to say three things very quickly. Firstly, there's no guarantee or certainty that Bitcoin is going to fall down to these key moving averages or these support levels. There's a probability, but there's no certainty. The second thing is there's no certainty that Bitcoin is going to hold these key support levels, which is why I mentioned the importance of stop loss. And the final thing is, this video is not a recommendation that you should also buy Bitcoin or that you should also follow the same strategy. I'm just letting you know this is a simple strategy that I quite like. Now, whether you decide to buy Bitcoin or follow the same methodology is a matter completely up to you. But the more important thing is that whatever we decide to do, we need to remember that there's a very strong and significant risk of loss, and we need to protect ourselves against those risks. All right, guys, hope this video helps. If it has, please give it a thumbs up, and also please subscribe for future updates. Thanks very much indeed. Bye for now.